So, we're going to be talking about banking crises and risk. Originally, I had intended for the remainder of the course to be a game theoretic model of monetary policy. However, given the recent events of the last month, with what happened with Silicon Valley Bank and then a couple of scares across the banking sector that followed, it seemed like it was a little bit more appropriate to try to cover what happened and then try to teach some of the lessons regarding how banks are supposed to be trying to model risk and where maybe Silicon Valley Bank may have fallen short, and what may or may not lead to a banking crisis kind of just in general. So let's just go ahead and get started in it. So like I said, we're talking about risk in banking. And we're going to be talking about what happens, namely when banks don't mitigate their risk the right way. But before we do that, we need to cover what this particular lecture is going to be talking about, which is how banks will be modeling the possibility of a loan default, and then what happens once this borrower has defaulted. Because banks face risk, right? They'll make loans with variable risk. These are their assets. So if you write a loan, right, you give somebody $100,000, they agree to pay it back over the next, say, 10 years. Well, that's awesome because, yeah, you gave them $100,000 that you had in liquidity, and then in turn, they're going to pay you back the principal plus the interest. Now, that is an asset because it's a guaranteed income stream, hopefully guaranteed, given, no default, guaranteed income stream coming in. But banks also have liabilities, and those are in the form of the deposits that people that bank with them give them. Right? So if you get paid, and you get paid, I don't know, you get a $2,000 paycheck. Well, you'll go take that $2,000 paycheck and deposit it with the bank. All right, now that's a liability that the bank has. And banks want to make sure that they don't face any default while people are repaying their loans, or really fail to repay their loans. So they've got various methods to make sure that their borrowers aren't going to default. And as somebody who has a career in banking, who has spent a couple of years working in risk for a number of financial institutions, I've actually done both the micro and macroeconomic sides of these methods to ensure that the bank will be able to survive a default in the event that there is one. And this works by having a microeconomic side where we will be estimating the probability of default for a various class of assets for these banks. Now there are there's other things that we can cover, but this is really the big one that I want to talk about. It's what I've got the most experience working in. But then the macroeconomic side is used to generate forecasts to understand these macroeconomic trends and then try to analyze whether or not the bank would be able to respond to these types of shocks. So let's say the economy goes into a recession, unemployment goes up by X amount. Well, if we understand what the macroeconomic environment is going to be like, then we can take the forecast for, say, a high unemployment rate and feed that into a probability of default model to see whether or not high unemployment is going to be correlated with a high or low probability of default. Now, I plan on getting into both of these in pretty good detail. However, first I want to talk about the micro stuff. We can get into the macro stuff later, and honestly, we've covered a lot of macro stuff throughout the course anyway, so let's get onto the microeconomic side here for a bit. So let's talk about defaulting. All right, default is the failure to meet the legal obligations of a loan. So you borrow money and then you don't want to pay it back. Or really, you can't pay it back. I'm assuming most people aren't sociopaths that are like, I borrowed $100,000 from the bank and then I gave them the middle finger and said, I'm not paying it back. All right, that's kind of a dick move, pardon my French. So if you default, the bank can come after you. They can wreck your credit. They can screw your life up pretty well. But if enough people default, well, all of a sudden the bank is now in trouble. The bank can't meet its financial obligations. And if they can't pay their bills, they go bankrupt. And it's not good when a bank goes bankrupt. So banks need to make sure that they understand the risks of default that they're going to face when they're doing business. So what they do is they hire a lot of nerds like me to figure out how screwed they're going to be if enough people default. And honestly, business is good. So we need a few different metrics to understand the risks of default here. There's the probability of default, which is just the chances that a particular borrower or a set of borrowers will default in some way, shape, or form on their repayments. There's the exposure at default, loss given default, and then expected loss. So what are all of these? What are these four things here? Well, definition time. The probability of default is the probability that a lender faces describing the likelihood of a default over a particular time horizon. So if you make a loan, the chances that somebody is going to fail to repay that loan is the probability of default. Next, we have exposure at default. Now, exposure of default is an estimation of the extent to which a bank may be exposed, given that we have this default here. So how do we explain this one? Well, if I had a $100,000 loan and I repaid $20,000, well, there's $80,000 remaining. And let's say I default on that $80,000. Well, the exposure at default is $80,000. So that's pretty bad, right? That's what their exposure is. But we have another metric here called loss given default. And this is the share of an asset that's lost if the borrower defaults. Now, maybe for a second you'll be like, hey, how are these two not the same thing? Well, the way they're not the same thing is exposure at default is like the dollar amount that the person defaulted on. The loss given default is the amount of the asset. So don't think like the dollar amount. Think of it is a dollar amount of the loan, but think of the dollar amount of that asset that would be lost if the borrower defaults. So $80,000 example, I default. All right, let's say it was for a house. Well, the exposure default's $80,000. The loss given default is different because let's say the bank comes in, they foreclose, they seize the house. Well, now they have this house that they're going to try to sell. Let's say they successfully sell it for $75,000. Well, that loss given default is the difference between the amount that I defaulted on, $80,000, and the amount they could recoup by selling the house, which is $75,000. So the loss given default would be $5,000. Now, finally, we have expected loss, and this is the sum of all the values of all possible losses, and each one being multiplied by its probability of that loss occurring. So let's say you've got two assets, and they each have a 5% probability of default. And let's say that each asset is $50,000. Well, what is the expected loss going to be? Well, it's the probability that they default for each one. It would be $10,000. That's the expected loss because there's that probability, the chance that they default. But there's also that 90% probability they don't default. So we need to be able to group those two things together. An expected loss covers that. So let's get into probability of default now. As we've established, banks make loans to their customers, and this customer repays principal plus their interest. Now, there are times where some of these borrowers can't pay back their loans and they go into default. So let's say you're a bank and you have 100 loans. 3 of them go into default. And you want to know what's this probability of default? We'll denote it P sub D, and it's anywhere between the 0 and 1 interval, including 0 or 1. You could say the raw percentage, that 3% of the loans that defaulted would be the probability of default, but you wouldn't be entirely accurate to say so. Because there are a lot of factors that lead to default, and if we don't control for them, well, we're basically just assuming it's chance. Is this person going to default, or is this one? Well, without having any additional information, each one could be one of those 3. But let's say we take some other factors in that are going to lead to a default, like income. If you have high income, chances are you're not going to default because you're not going to find yourself in a situation where you can't repay your loan. If you're making $500,000 a year and you take out a $30,000 loan, that thing's going to be repaid. Next, you have like your credit score. Well, a high credit score generally indicates a low probability of default. Now, when it comes to your credit score, there's a lot of things that make it up, right? There's like the length of the credit history, value of existing loans, your repayment patterns, the credit utilization that you have. All those things feed into your credit score. And we also have our residential status. Residential status is like, do you own or rent your home? Because if you own your home, right, there is at least some form of collateral that could theoretically be used in the event you take out a loan and can't pay it back. So there are all these little things here that would feed into understanding the probability of a default. Now, the thing is, this is where things get a little tricky because we don't know the true probability of default, nor do we observe any probability of default directly. Because all that we're seeing are loans that do default, and then we're seeing loans that don't default. And we've got to use a regression model to try to estimate the probability of a default. And this probability would be based on the possible factors in the previous slide. But the thing is, the model has a binary outcome. It's either 0 or 1. You either do default or you don't default. There's nothing in between. So this model is going to be used to forecast possible defaults in the future. And if we can assign a probability of default, given things like income, history, etc., we can break down each individual component that possibly leads to or possibly predicts default, and then try to use that to move forward and go, hey, maybe this is a good candidate, this is not a good candidate, right? This one's a little bit more creditworthy than this one. So as banks get all of that stuff together, they get a more comprehensive picture of who is and who isn't worthy of borrowing some money from them. So let's go through an example of a probability of default model. Now, this is a very simple example because I'm not putting any numbers in or anything like that. I just kind of want you to see what it looks like. And so we're going to be developing a PD model where the borrower defaulting is a function only of the size of their credit card debt. So the dependent variable is binary. It's 0 for no default, 1 for a default. The independent variable is the size of the credit card balance. So the idea would be that if you have a high credit card balance, it's likely going to increase the probability of a default. Because, well, if you've got, say, a $30,000 credit card balance, the chances you default are going to be a little bit higher than if you've got a $100 credit card balance. So what we do is we use a simulated data set with 1,000 samples because you don't want to use real data on this. Oh my God, the privacy, the laws that would be broken in that situation would be a nightmare. Like, oh, hey, look at all this real data that I got that I then just put up on YouTube. Like, that would be awful. So it's simulated data set. And we pair up borrowers who either do or don't default with the size of their credit card debt. So each observation is going to have an XY pair, where X is the credit card balance and Y is whether or not they defaulted. And this is what it would look like. So these little black dots down here and up here are, here it's if they did not default, and here it's if they did default. Now, what can we notice about this? Well, first, there are a lot more observations that don't default than observations that do default, thankfully. But in addition, a lot of these non-default situations are generally pretty low, generally below $2,000. And a lot of these default situations really pick up around a $1,500 balance. So a higher credit card balance is going to be correlated with a higher probability of default. And that's ultimately what this blue curve here is giving us. And it's what's known as a logistic regression, or if you're an econometrician, like a logit model. And it is used to estimate various probabilities. In this case, the probability of default. It's a very useful model in banking. But anyways, we can move on from here because, well, we can talk about what this means. So the grouping of ones is typically associated with higher balances. If you've got higher credit card balances, well, there's a higher likelihood that you're going to default on them. Now, conversely, lower balances tend to be associated with lower defaults. So if we were to look at this for, say, individual hypothetical credit cards, right, or people with credit cards, I should say, we'd find that the probability of default would be higher for people who have higher credit card balances. Now, obviously, there's a lot more to it than just this, because the size of the balance clearly makes a difference, but what about their income? Because you could have a $10,000 credit card balance, which is pretty big, but if your income's $500,000 a year, there's very little risk of default, right? And chances are you can just pay that off, like, by the end of the next statement. So that's not entirely, like, just looking at the credit card balance isn't really enough for a good picture here. But let's say someone could have a $4,000 balance or even a $1,000 balance, but their income is $15,000 a year. That would be a very different story because that's going to be much more difficult to pay off than the person with a $500,000 a year income with a $10,000 credit card balance. So we need other variables here as well to really give us a full picture of the story, but that's not for the scope of this lecture or this class. Although if you are interested in, like, credit risk modeling and stuff like that, we can definitely have a one-on-one conversation. Totally looking forward to it. So now that we know what probability of default is, we can move on to exposure at default. Now, exposure at default is the predicted amount of loss that a lender is going to incur if a debtor defaults on that loan. So it's the realized value of what the bank could lose if the borrower doesn't satisfy their debt obligation. So like I said, $100,000 home loan, $20,000 of it gets paid off, and then the loan defaults. Well, they've defaulted on $80,000. So the exposure at default is $80,000. And there are a couple of ways to compute this. There's the foundation approach, which is guided by the regulators, and then there's the advanced approach, which allows each financial institution to kind of compute things the way that they think would be best. This is all set out by the Basel II regulations, which we can get into later. Actually, we will be getting into later. It's not can, it's will, because it's all very important stuff to understanding what happens with banking crises. So that was exposure default. Let's talk about loss given default. Well, this is the estimated loss that's incurred by a lender if the borrower defaults on their financial obligation. However, we can express it either as a percentage of the total capital at risk, or we can express it as the dollar value of the capital that's at risk. So let's think of it this way, right? So we can go back to that $100,000 loan, $80,000 default. So in this case, the bank can seize the asset because it's a house, and they can resell it at $75,000. If we're going to express loss given default as a percent, well, it's 6.25%, 5,000 divided by 80. Now in dollar form, right, well, that loss given default is $5,000 because it's going to be the exposure default times 1 minus that recovery rate, right? So the recovery rate in this case is 100% minus 6.25%. What is that, 93.75%? So that is the loss given default, like in dollar value, because it's assuming you can recoup at least some of your losses by reselling the asset after you've seized it, assuming that you can. Now, it's easy for a home loan or a car loan because they can just take it back they can take it away from you and resell it. But if you've got an unsecured loan, right, a loan that's not collateralized by a lien on an asset or protected by a guarantor, it's not really so easy. And that's why, like, if you were to get, say, a personal loan, it's going to have a much higher interest rate than if you got, like, say, a car loan. Because the car loan, right, there is some collateral that you have, the value of the car, that can be seized if you stop making your car payments. But if you take out a personal loan and you stop making payments, well, what are they going to recoup? Like, their dignity? Not happening. So for loss given default, let's take the formula from the previous slide, learn to compute it. All right, well, we need the recovery rate, which here is 93.75%, $75,000 over $80,000. So 1 minus that recovery rate is 6.25%. We would take that recovery rate, or that 1 minus the recovery rate, and multiply it by the exposure at default, which is going to give me $5,000. So there's a couple of different ways that we can compute loss given default. Now, the thing is, neither loss given default nor exposure at default consider the probability of a default, because it's just the amount that the lender is going to lose in the event that a default occurs. So by itself, it's not necessarily a great metric to use, because it needs to be used along with other metrics like, say, the probability of default. Now, if we were to compare loss given default to exposure at default, we see there's really kind of like a range of possibilities. You can sort of think of these as like an upper and lower bound on the best and worst case scenarios. Exposure at default would be the worst case scenario because you're assuming you just lose everything when the borrower defaults. Now, loss given default would be more like a best case scenario because theoretically in this case you're losing very little if there's a default. So we can sort of think it's like an upper lower bound here. Now, from all of these, we can compute what the expected losses for the bank would be, which is now covered in this slide. Because we need to be able to derive a measure that can describe the expectation of our losses. And this ties the probability default, exposure default, and loss given default sort of all into one metric that's usable in a credit risk context. So let's first start out with our losses. Right? Well, this would be exposure at default times 1 minus that recovery rate. In this case, right, that 1 minus recovery rate, if we're sticking with the previous example, 1 minus the recovery rate is 6.25%. Right? That's the amount that you can't recover. Now, this could be a lot. It could be very little. But the thing is, we need to know what the probability of actually losing all of that would be, because that probability is really going to be dragging down or dragging up the expectation of these losses. Because we could have high losses, high potential losses, but the expectation of losing it could be so low that the expected losses are minuscule. So we're going to multiply those losses by the probability of default. So if we take our losses, multiply it by probability of default, we get our expected losses, or the expectation on the losses that we possibly face. All right, so remember, the amount that we can't recover is 0.0625, 6.25%, and we have exposure default of $80,000. So we multiply those two guys together, we get $5,000. Now, if there's a 3% probability of default, then we multiply that $5,000 by 0.03, and we get, you guessed it, $150. So think of it as the amount of the defaulted loan you can't recover times the probability that you'll actually lose that. So while you may lose $5,000, the probability of that is only 3%. So the expectation of that is 3% of 5,000, which is $150. So finally, why do banks do this at all? Well, we're going to get into this in the next lecture. But the idea is that banks need to be able to maintain adequate capital requirements. Now, capital requirements are the amount of capital that a bank has to have as required by its financial regulators. This is not the same as having, say, required reserves on hand to be able to, make whole year depositors. These are requirements that are put in place to make sure that institutions don't take on excess leverage at the risk of becoming insolvent, in which case they have insufficient assets to be able to repay their own financial obligations. Now, nobody wants a bank to end up in a situation where they can't cover their depositors that they, should they want to withdraw, nor do we want a situation where the bank can't meet its other financial obligations, right? Because banks make loans, but they also take out loans. So, it's kind of like I'm repaying this person is repaying me, so there's like money just circulating all over the place. Well, if one of those banks stops getting paid, and they stop being able to pay, well, you have now screwed up that whole process. The whole circular process now gets stopped. Not a very good thing. So these requirements help protect everybody by making sure that the banks can withstand any foreseeable issues. And these capital requirements will help maintain and ensure the capital adequacy ratio of a bank, which we'll be getting into in the next lecture, which is the percent of capital to its risk-weighted assets. We want to make sure that's sufficient. And I don't even know why I'm saying it's no lower than 8% in this lecture, because that's really a next lecture thing. But we'll be getting into this later. As I said, if time permits, and here, but ultimately it's going to be the next lecture because, well, why not? Once we cover that, I'm thinking we're probably going to do some of the macro stuff and then try to jump into what happened with Silicon Valley Bank because it is a pretty interesting topic. And given the relevance and the shape of current events, I think it's something we ought to do. So I hope you enjoy the stuff. I hope it's somewhat useful to you. Stay tuned for the next set of lectures. Thank you for watching this one. And, well, I'll see you later.